good morning. You're watching The Market right here on 89 with me, Aisha Faredi, Avan Dabash, Nikunj Dalmia joining in shortly, and 21K already here on the Gift Nifty. So that's the level we're staring at. Even in the market trade yesterday, we've managed to gain for sixth consecutive days in a row. But yesterday too, after a bit of a quiet start, we finally perked up and we managed to close in at the session highs. So almost within distance on the Nifty spot with that 20,900 print, and the Gift Nifty already indicating a positive start. I mean, I know you can see that Dow closed in a little soft, but guess what? Post the state election verdict, we seem to be charting our own territory, not really taking into account what the global cues have been handing out. We're pretty much in a trajectory on our own. And there you go, Nikunj, the Nifty implied open. I think that itself is the prettiest picture.
I mean, 21,000, can you imagine for a market which was struggling to cross even 19,500? Now we're looking at 21,000 and I don't think we are done yet. Global cues are also favorable. FIs are back. The underperformance in banks is getting checked. Now, the market action is clear that big institutional investors, big HNI investors, they're simply taking a leap of faith now. While we can talk about Nifty at 21,000, banks making a comeback, there is also a rotation which actually started in small and mid-cap stocks, and that's something which we'll talk about as we go forward. So in this market, if you're bullish, well, you have to respect the trend. The mistake what a lot of people do when you are in a grip of a very strong bull market is that you try to be cute, you try to time the bull market, which is that, okay, you buy, but you sell quickly in anticipation that markets will come down and you will participate again. So in this kind of a trending bull market, just stay on the course. Markets right now are going through an extraordinary bout of momentum and an extraordinary comeback by global institutional investors. So I guess the best strategy in this market is just stay on course. Large cap stocks and especially banks are in a good groove, and you want to be in that space and you want to maximize this kind of an setup.
Yeah, but I think for investors who were in any case fully invested, I guess they've made a killing. But those who were underinvested and now are feeling the FOMO that maybe I should buy in now, I think the bigger debate is that.
So Aisha, look, let's assume that you were waiting, you were on the sidelines. Either you were worried because of the political landscape as to what will happen to the state election verdict, or you in a sense did not participate and you were afraid of a sell-off. So the FOMO effect has definitely kicked in. But even if you jump in now, let's look at the realistic picture. Even if you jumped in now and if you buy large cap stocks, I think large cap stocks still have potential to giving you a double-digit return in 12 to 18 months. Equity in the long term has generated returns anywhere between 11 to 14% depending on the patch which you track. So if you're feeling FOMO and if you've ignored the channel advice of not selling and staying invested, then today also if you jump in with a slightly extended time frame, and if you buy large cap stocks, select banking names, select private bank names, some manufacturing names, couple of consumer names, the markets are not terribly expensive. There is no bubble in the market. So it is not that the train has left the station. Yes, there are small and mid cap stocks where you really need to be careful, and I'll just emphasize on this part here. So let's look at what is happening in the market. Suzlon from the 52-week high, JP Associates from the 52-week high, Reliance Power from the 52-week high. Some of these stocks have already started turning. So that is Suzlon for you yesterday. But from the recent 52-week high, Suzlon is down more than 10%. JP Associates from the recent high, the stock has reversed completely. So that's 40 the 52-week high for Suzlon. From there it has come down to 39.5. Similarly for JP Associates, similarly for Reliance Power. There are a lot of rank mid-cap stocks which just went up because of a hot air phenomenon. They've started reversing. So this is where I think markets are telling you that if you miss the rally, it's okay. But if you want to jump in, you don't want to jump in on these stocks. You want to avoid small cap stocks. You want to avoid some of the rank mid cap stocks. The margin of safety is there in large cap stocks, and which could be a happy hunting ground for next couple of days.
Yeah, happy hunting ground indeed, given the fact that we have seen the likes of the heavyweight banks, the likes of Reliance Industries as well, perking up. But the other factor that the markets will have on their mind, I mean, Nikunj, you alluded to a number of positives, and then there's the GDP print, and that, of course, is going to be fairly, the RBI is going to be cognizant of that. Remember, they're preparing now for their 3-day monetary policy committee meeting that starts today, and the expectations are rife that the central bank going to maintain a status quo on the repo rate, so leaving it unchanged at 6.5%. That is what the ET Now poll is indicating. And by the way, this will be the 5th consecutive time that the MPC is likely to keep the interest rates on hold again, and that's largely on account of the upturn in growth in the GDP print as well, Nikunj.
See, Aman, from a market standpoint, I think this time's credit policy purely from an rate standpoint is going to be a no-go. I don't think anybody is expecting anything very meaningful there. The GDP data has surprised everybody. Commodity prices have started coming down. So growth is on track and inflation is coming down, and liquidity in a sense is now manageable. So I think the setup, at least on a macro standpoint from a Reserve Bank of India's standpoint, is not very troublesome. However, the chink in the armor, I think, is what everybody would like to understand from Reserve Bank of India, that why 2 weeks ago they came out and they really raised a red flag for unsecured loan. Is there a trouble which Reserve Bank of India is spotting in the unsecured loan book? One. Second, what is the read of the rural economy? If the GDP print is strong and if government spending is strong, then how are they viewing the K-shaped formation of the economy, and do they really see a recovery happening there? And see, could it be problem of plenty for Reserve Bank of India going forward? Suddenly flows from FI front, FDI front, bond inclusion, all those factors would be at play in 2024. So how are they really preparing themselves to manage the market risk and the market volatility? That was the status in the last credit policy meeting. Crude was at 83, it's come down to 78. The 10-year paper was at 4.7, it is at 4.2 now. Inflation, that's the Indian 10-year yield, 7.2, 7.3, that's okay. And inflation directionally, I think, is going lower. We are no longer crying for onions and we are no longer crying for tomatoes and potatoes. So things are manageable now. And sometimes Reserve Bank of India just gets everything. I think you are in that stage. The narrative, the faith, the macro, the landscape, the liquidity and the inflation. So touch wood, but this is like a great scenario. If you are an RBI governor state, you would say, okay, what can I say? I mean, I just need to...
I just have to sit back
exactly.
manage the
exactly.
narrative.
Just manage the liquidity,
Yeah.
make sure that there is no bubble in the unsecured loan category, and the rural economy actually comes back. I mean, if this setup continues for next couple of weeks, then 2024, it could be problem of plenty rather than problems of scarcity.
Yeah. Okay, that's the take coming in on what the RBI governor would do. Of course, we will find out on Friday. But just want to quickly, swift through the global cues as well. US equities clearly overnight have managed to take a bit of a breather. You've got the 10-year yield, which continues below that 4.25% mark post the jobs data coming in. Gold has eased off a little bit from that all-time peak. Oil continues range bound, and Bitcoin, well, guess what? It's past $43,500 mark. So yeah, I think it's the first time, and a very unique time at that, when you're seeing equity markets, both US, India, you're seeing gold and you're seeing Bitcoin, all these asset classes sitting at an all-time high. But Adrian Mowat is here with us today. We've also got Anurag Singh to talk about where they see India and the world headed. Gentlemen, both of you, good morning to have you on the show. Anurag, let me start off with you. It seems like a big re-rating happening for India post the state election verdict. You think the rally has more steam to go?
Yeah, morning, Aisha. And I think if ever there were some doubts about Indian markets, I think they've all been put to rest now. So it's a very clear bull case for India. And I think, I mean, to a certain extent, I feel little, that Indian markets have become boring. They just never drop. They just only go up, or they just take a breather for a while. I think that's where we are. I would not be surprised if we can rally even up to 2200 from here. It's not a prediction, but looking at the way it's going, I think we just need a little bit of a stopping of selling by FIIs, right? And rest all will follow. So yeah, clear case, bull case for India, Aisha. That's how I see it.
Adrian Mowat also joins us now. Adrian, good morning. Thank you for joining us. Adrian, it's a very unique market. Gold is rallying, Bitcoin is rallying, bonds are rallying, and equities are also rallying.
Yes, it is. I mean, to me, I think the thing that surprised me the most is the move in the bond market in the US. So US bond yields were 5%, almost, well, they did intraday go above 5%, and they've rallied back to below 4.2%. I see that as one of the risks at the moment. The US economy continues to generate jobs. It's growing in a very robust nominal rate. And I think the Fed is very unlikely to be changing its reference interest rates in 2024. And that means that bond yields are mispriced. They are too low. And I think you're going to continue to see these patches similar to what we experienced in October, where you have quite high volatility in the bond market as it tries to, what I would think is reasonable, is return to a non-inverted state. And so to me, that's the risk out there. The story for equities remains robust globally. You know, growth in the US remains strong. The sales growth for US corporations is very healthy. The drag from a strong dollar is probably behind us in terms of the worst. And then, you know, if we move into the emerging markets like India continue to offer a very robust economic growth story with probably declining inflation risk, which is a very bullish story.
And wanted to also get in a perspective from you, given that you've alluded to the fact that a lot is working when it comes to the global as well as the Indian macroeconomic backdrop. What do you think the next big concern could be for our markets, or the next big risk that we really need to watch out for?
Well, you know, as I was saying earlier, I am concerned about volatility in the bond market leading to, I would view them as market corrections that are buying opportunities. So I go back to, it makes no sense to me that the US yield curve is inverted. It's extremely inverted. You'd have to go back to the Volcker years in the 1980s to get the current arithmetic level of inversion. If you think of it more on the geometric basis, back in the 1980s, Volcker put in the Fed funds rate to 20%. And the curve was inverted by a couple of percent. Now you've got a inverted yield curve of the same level, but the reference rate is 5.5% on Fed funds rates. So bond markets worry me. I think people are too complacent about the long end. And so I continue to see that as the source of volatility, as it has been since the beginning of 2022.
Anurag, is it getting too good to be true? Suddenly, equity investors, bond investors, or for that matter, even those who are buying gold and Bitcoin, they are forgetting that any asset class has got an underlying risk. It's just getting too good to be true, right?
No, so Nikunj, and I heard what Adrian has had to say on this, and look, those concerns were real, and for the last 2 years, Nikunj, we have spoken several times. I have always stuck to the guns that there is a bear case. But I've changed my stance in November 14th when I saw the CPI data. I mean, there are reasons why the market feels, and that was a watershed kind of, at least for the US markets, November 14th, when almost everybody, took their, bear case off. Now we have projections right from 4,700 to 52, 5,400 based on which investment bank you believe. But here are a couple of solid points which tell us that Fed might actually have achieved that improbable soft landing. One is, you look at the inflation, the core services inflation that Fed watches, which is core services net of housing. For the last 6 months, that's running at 3%. For the last 3 months, that's at 2.75%. Now that's as close to the Fed target that it, as it gets. Second is the softening labor market. Now today, the ratio of the jobs to unemployed, that used to be like 2 at the height of post-pandemic scenario. Now it's at 1.3. So it's coming close to that 1.2 balance that Federal Reserve wants. Unemployment 3.9%. We'll see what the number next week comes or this Friday what the number looks like. But if it is close to 4%, the economy anyways is missing about 2% of the workers which retired. So we're pretty close to 5.5, 6%. That's as tight as it is going to get. And finally, earnings, Nikunj, despite all the talk of the kind of impending consumer pulling back, earnings this year, S&P is again hitting at 220, which is the same as last year. So ultimately, look, last 2 years, we have moved from 0% to 5.5%, and earnings have held on, consumer has held on, the jobs are here, and it ultimately looks like a Goldilocks soft landing. So I think it's very hard to now reason out. Okay, and here is the final point. In case something breaks, and we can debate on the yield curve and inversion and all of that. But in case something breaks, Fed has the cushion to come and cut rates, right? So predictions vary from when they will cut in March to April or September next year. I believe they will cut, the threshold of cutting the rates is a little later, probably next September. But they can always come back and rescue the economy by cutting rate this time, right? Which was not there for the last couple of years. So I think you put all of this together, it's not, at least in US, it's not too good to be true. Maybe if you take off the minus the Magnificent 7 stocks, you find the rest of the 493 are very reasonably valued.
Sure. That's the other thing, Adrian, if I could get you in here, because, we were just discussing, for those who are fully valued in the market, they're enjoying the party. But those who are undervalued, and clearly feeling FOMO, they want to know where should they park their money. Is it kind of obvious that you got to steer clear from the mid and small caps? They've already had their day in the sun, Adrian, and would you stick by with the large caps, and especially the ones which have lagged?
Well, look, I think there's a case for buying the laggards, and you're noting in the introduction that the banks, which have been underperformers year to date, seem to be participating in this rally. I'd be pretty open-minded to looking at small and mid caps. The underlying economic growth story is good. There is no reason why these things shouldn't be performing. Now, I think the underperformance of small and mid caps has been more modest in India than we're seeing in other markets. So I think that's quite an interesting space to be looking at globally. And I, concur with the comments earlier that what we've got to remember here is if something does break in the global economy, let's say the refinancing risk that will be very evident next year, the Fed has the flexibility to cut rates at 5.5. So we're back to having a Fed put, which just gets me back to thinking, look, where you should be is you should be in equities. You should be avoiding bonds. And if you want to park money, you can just park money in cash at the short end and get a pretty decent yield. But I think the environment for the next 12 to 18 months is one very much of you want to be long equities.
All right, gentlemen, thank you for putting that into perspective and giving us a sense as to where the India story currently stands. Let's move right on and track levels then. And we've got our chartists standing by. We've got Kunal Bothra as well as Naresh Mirani joining in as always. And look at where we are, Kunal, with the index gaining for the 6th straight day on the trot. The fact that you've got the Nifty Bank as well surging, and how. What do you make of where this is likely to take us? What's the best case scenario in terms of your optimistic target price?
See, I think, we've now come back towards a very strong psychological mark. Hopefully, if the GIFT Nifty shows what it's indicating right now around 21,040 plus mark, we could probably expect the spot also to come back towards 21,000 levels. Now, this could be an interesting play because after breaking past above psychological 20,500 mark, we've seen a change of stance from the option writers from being extreme amount of call writing prior to the event at the 20,500 strikes. We've seen the 20,500 strike now acting as a hub for put writers. But on the other hand, 21,000 mark has also seen a good amount of option writing or call writing. So I would probably expect now for the next couple of days, maybe some bit of consolidation or some bit of resistance to come back at that 21,000 levels. So I think hopefully till the expiry tomorrow, we could expect 21,000 to be a minor resistance at play for the indices. But this is nothing to dissuade trader, because in the sense many of the large cap stocks are still looking very attractive. We've seen banking stocks showing an absolutely strong recovery, especially the larger cap names and the ones which have been underperformers. So I believe that part of the trend would still continue.
All right, let's get in your take then, Naresh, as to what you're making of the levels, given the fact that we are looking at a pretty strong rally coming in across the board and a smart move for the frontline indices. What do you make of that?
So overall, the momentum is pretty strong. We are getting a little bit on the overbought zone, but the fact is we can remain overbought much longer than we think. But time to take some profits of partial profits on Nifty and Bank Nifty on a gap up open today, because we've seen a very strong move. So if you look at Nifty Bank, we've gone up from 44,500 to almost 47,000, 47,200, 300 if we open well. So structurally, the trend is positive. A lot of parameters are giving fresh breakouts. So you have a fresh breakout on Bank Nifty. You have fresh breakouts on a lot of stocks. We have a fresh breakout on the Nifty 50 in US dollar terms. So overall momentum is pretty strong. One wants to buy on dips, but would tough to get a dip today as well. So overall, partial profits and then continue to trail onto the position. 21,000, 21,200 on the upside, and then 47,500 on the upside on Bank Nifty could be a small pause area.
Okay, let's talk stocks then. Kunal, what's on your list?
So I'm betting on two names. One is a fresh breakout candidate, that is ABFRL. The stock yesterday managed to break past about the 240 hurdle, and on closing basis, it's completing a cup and handle kind of a pattern on the daily time frame chart. Of course, breaking past about the key moving averages as well. So buy with a target of 255. Stop loss could be kept at 234. And Kotak Bank is the other name from the banking stock, which is given a breakout a couple of days back about that 1800 levels. Managed to move up yesterday as well consistently. So would reiterate a buy on Kotak Bank. Targets kept at 1880. Stop loss revised higher to 1790.
Right. Naresh, what about your stock strategies?
So first is a buy on Maruti. The stock has made a very strong base around the 10,000 mark after the breakout and has been testing that 10,800, 11,000 mark in the near term. So it's waiting for a new fresh all-time high out here. So expecting a move in the short term towards 11,300, 500 levels. A stop loss to be kept at 10,500. Second is a buy on IndusInd Bank, which continues to sustain around that 1480, 1500 mark. Yet to give a meaningful breakout, but the risk reward still looks interesting. So a stop loss at 1470 and a target price of 1650.
There you have it, all of your top recommendations, and of course, financials making a mention. Let's get a move on then and focus in on some stocks and news as well. And Anish is here to decode just that. We're discussing Asian Paints and autos. So let's begin by talking about CLSA's latest note on autos and what some of their views are.
Well, yeah, that's a question a lot of investors have also been asking, that what to do with the auto stocks after this rally. What CLSA is suggesting is that perhaps you should book profits because they've downgraded the sector. They are saying, yes, the volumes catch up might be there, but you need to be cognizant of the valuations and the stock prices. And they think that the stock prices are fairly valued right now, led by the sharp rally that we have seen recently. That's why they've downgraded Eicher Motors, Bajaj Auto, Hero Motocorp, as well as TVS Motors. So they have, in fact, Bajaj Auto, there is a big downgrade coming in because it's downgrade to underperform from outperform. So it's a double downgrade coming in, and this is despite them hiking the target price to around 6,300 rupees. In terms of the volumes, they are expecting that there will be recovery in the volumes, but they're saying that the two-wheelers and the electric vehicle is something that will drag the margins of the companies, and also the fact that premium motorcycles are likely to do better than the mass segment, and that's the reason they have downgraded Hero Motocorp as well to outperform from buy earlier. But Nikunj, would you concur with the view that the best is done and probably it's time for that sector turn to happen?
So Nisha, between September and now, if you look at the best performing Nifty 50 stock, it is actually Hero Motocorp. And if you look at a category, real estate and autos are two categories which have done rather well. I think in the near term, given that there is going to be a definite push by the government to stroke up the rural recovery, the narrative of the market will always think that ahead of election, government spending, rural economy needs, has been limping and it needs some kind of a push. I will not be surprised that if rural denominated themes they do well, within that two-wheeler I think may just tend to outperform. That's the near-term market outlook. But in my view, Anisha, when I speak to folks and when I look at reports, I think for the two-wheeler sector per se, we have to understand that few things are changing. One, the environment is changing. B, the technology is changing. and see the competition is changing. Environment is changing, everybody is moving towards EV. Technology is changing because ICE in a sense is now getting less and less. ICE engines now are going to be, they will have to do something different there and see competition. Who would have thought that a player like Ola actually would have such a large inroad into the two-wheeler space. So I think in the two-wheeler space, you are actually at a cusp of big changes and which will subdue the long-term terminal value. So in the near term, because of the narrative of the government, because of what markets believe, the government push towards rural economy, I think two-wheeler stocks and rural denominated stocks will do well. But in the medium term, 3 years out or 5 years out, I think we are looking at a shakeout there. And anybody who's got technology, who is taking the EV portfolio the right way and is really able to create more terminal value would be the real leader in the two-wheeler space. And as of now, markets are saying it's not going to be Hero MotoCorp. As of now, markets are saying it's not going to be, Bajaj, but it could really be TVS. That explains why TVS has done well. So while you can argue about the valuation and the recent run-up, but I think there is still some more fuel left in the tank for this entire rural denominated theme to extend itself ahead of elections.
Okay, and Anisha, Macquarie pretty upbeat on Asian Paints. What's the rationale?
Yeah, I think the management met a couple of analysts and the commentary is something which is very positive. What really stood out for me in the commentary was the line that says that they have reiterated the double-digit volume growth expectation, not only for the second half, but the next 5 to 7 years. So that entire worry around competition coming in and the growth rate slowing down, that seems to be abating because they're giving you the visibility for the next 5 to 7 years that the double-digit growth in terms of volume will really continue. But yes, coming to Macquarie, they've maintained outperformed rating with the target price of 3,800 rupees. They're focusing on the budget, end of the market to grow their, revenue as well. They are intending to launch differentiated offerings in the budget end, and that will help them to gain the market share from the unorganized players. Of course, in terms of the new competition, Macquarie has a view that Grasim will need to focus on brand development as customer pains 1 in 6 to 7 years. So it will take that time for them to build up that amount of brand value. And of course, the other verticals is something that you need to watch out for as well. UBS has actually also written a note on Asian Paints this morning. They've increased the target price to 3,900 rupees versus 3,800 earlier. They are saying that Grasim will take a lot more time to catch up versus Asian Paints because they will have far less impact on the market share and margins of Asian Paints because they'll have to prepare a lot more in terms of distribution model and working capital to catch up. So that's the latest coming in on Asian Paints. But Nikunj, your view in terms of how the valuations stack up and your entire argument about rural versus urban as well, how does that stack for Asian
See,
Paints?
let's look at the problem for the entire paint sector. Competition is only intensify. But just because competition has intensified, that does not mean that there is going to be a change in terms of market share. Since we're talking about two-wheelers, let's use that as an example. Everyone said, okay, Triumph and other Harley and other bikes are coming in, that is going to eat into the market share of Eicher. But guess what? Eicher's market share is protected because of the unique offering they have. I think Asian Paints, in a sense, has a huge advantage in terms of brand reach and distribution. And now that growth is coming back and crude price is also supportive, I also feel that this entire view of the market in terms of what competition can do, I think has been over amplified because Asian Paints in the past also has demonstrated the ability to do something very different. It's a professionally run team and I think they've done excellent work there. The problem for Asian Paints was valuation, which I think are now looking reasonable. Second was crude, which is now manageable. And see, when a company like Asian Paint on a large basis talking about such volume growth number, it's a conservative management, they always shy away from making forward-looking numbers. Then you would say that, okay, they really mean business here. Asian Paints is nothing else but it's a multiplier on GDP. GDP plus couple of percentage points, and that's how Asian Paints would grow. And if GDP is growing at this rate, then demand surely is making a comeback. So let's see, time will tell whether this bullish thesis will come right or wrong. But I've seldom seen that large brands, they feel a shakeout even when competition has intensified, even though they may be coming from the house of Jindals and from Birla. Look, when Jindals came in, we thought, okay, it's going to change the dynamism. It has not changed the dynamism. It has come and gone. I mean, it's not eaten into the market share. And other players, there were so many players, but what has happened? Only 3 players have survived. Yeah. So it's not going to be like a cakewalk for Grasim.
Okay, fair enough. That's the view Nikunj's take on the entire paint sector. Anisha, thanks so much for joining in. We'll take a short break. Be right back. Welcome back. Let's connect with Sanjeev Bhasin as well, who joins in on the show. Good morning, Sanjeev. And clearly, the stage is set for 21K in sight. In a market like this, the question is, for those who have been sitting on the sidelines or waiting for a ripe entry point, what's the advice?
Yeah, good morning, Avan. Well, there is no advice. There is just this, that equity has no timing. It is how much time you spend in the market. So choose your SIP, choose your mutual fund and try and get in, or seek some brokerage firm which can advise you better. And the owning of an asset class called equity is the underlying theme, which has been why you've seen the amount of SIPs which have been the rock behind the wall, and which have counteracted all the FI selling. So I am of the opinion that maybe in the near term markets are looking stressed, but look for the slightly longer term. If we do get a continuation of the present government, then there is no holds barred for the next 5 years. Plus the economic reality is here. Crude is at a 3-month, 4-month low. Bond yields are hitting lows. So all is set for 2024 to welcome equities in a new space. And now you have the left out feeling maximum for the foreign FIs. So no timing the market. It is today only start your demat account or your SIP account and open a good mutual fund as a SIP for the next 3, 5, 10 years.
Okay, fair enough. And a pretty stellar rally that we've seen in the large caps. They've clearly been dominating, and the Nifty Bank Index in particular has been proving its might. Where is it that you're hunting for opportunity within the financial space?
So, Aman, you can see that clearly the biggest underweight was banks and IT, and banks have just seen some sort of a comeback. But the comeback is so huge because there was a huge amount of shorting on the Bank Nifty below 45,000. I am now of the opinion that the Bank Nifty, which had lost momentum, is now in leadership. And obviously, you will buy the frontliners, which for the large caps, or the liquidity purely is in HDFC, ICICI and Axis. But I would single out Kotak to be the biggest outperformer here. I think it languished after the last 4 months, but I think Kotak's earnings, its new management, and the continuity give me enough comfort in Kotak. On the small caps, I am very, very optimistic on Bandhan from that 215 level. It has hit 235, 240, but do a sip in Bandhan. The present management is talking of doubling of profits and all bad news of provisioning in the price. So these are two stocks which I would recommend. However, for retail investor, doing a sip or buying the Bank Nifty Bs would be an ideal way of doing, participating in a basket of stocks.
Right. Sanjeev, hi, morning. You made a very interesting point that at these levels you think that the market is looking a little bit toppish and valuations are looking a little stretched. Where would you recommend profit taking then, if at all, for those who are looking at a more, short to medium term time frame in the market?
So I said clearly PSUs and power. Be watchful over there. I'm not saying that they can't run up more, but when in bull markets, you must leave something on the table since you have encashed good value. I see them a lot of froth on the power side. But on the other hand, I would definitely advocate IT, real estate, and even, consumption. I mean, I've been advocating Asian Paints from 3180, 3200, 3130, 3150. I think Asian Paints is a pedigree stock. And, the management's commentary yesterday was very, very optimistic on the growth outlook. So do a recce of where you are, but get into large cap, IT, real estate and consumption. There you have enough comfort and visibility on the upside.
Okay, fair enough. And Sanjeev, let's also get in your take then as to what you make of the entire auto space. Reports coming out saying that now it's time to book profits. Now perhaps the best is behind us when it comes to large cap auto as well. Do you concur with this assessment?
Auto has been the biggest outperformer in this industry in the last 1 year, and no realms that all stocks are hitting new highs. So if you took some money off TVS Motor or an Eicher or a Bajaj, no harm done. But look where you will re-enter. So I would say if you get out of those stocks, then get into blue chips. And that's why we have suggested IT, real estate and consumption. You can add some of the banks which we say. But yes, I think auto numbers, the monthly sales and all the good news is in the price because the stocks have run up far in excess of valuation. As a disclosure, we have been periodically selling auto and getting into other sectors. Auto was our biggest heavyweight in the last 1 year. And like you rightly pointed out, there is no harm in taking some chips off the block.
All right, no harm in taking some chips off the block. But in the meantime, let's just take a look as to what the pecking order was in yesterday's trading day, and clearly dominated by the entire Adani group of stocks. That's where all the action was. In fact, you did also see the overall market capitalization of the market gaining about 2.9 lakh crores, and the Adani group of stocks contributed to close to 1.9 lakh crores out of that total market capitalization. Let's get a view from you in terms of, Sanjeev, whether or not you expect the Adani group of stocks to really lead from the front, down the line as we see the market rally play out.
The 100%, I think they are going to be the biggest gainers of, rubbishing of the Hindenburg report. And that is where we stuck our neck out in early February when there was chaos. Underlying assets are extremely powerful, and the cash generations have always been, at the forefront. I still think there is value in Adani Port and Ambuja. These are two stocks which we have in our portfolio. We will not sell even if they, give you 50% upside. We think grossly some of the, sum of parts plays are very, very attractively priced. And I don't rule out another 25-30% in the near term to maybe the next 2 months coming in Adani stocks. The sheer underweight and the relative, shorting on these stocks was tremendous. That's why you've seen, when did you see 18% rally in the largest of large caps in the index? So it's telling you that the pessimism was overdone. Now you're seeing ground reality where the underlying assets are doing well, and you have the tailwind now of positive dilemma on the political and on the Hindenburg side. So Adani Port and Ambuja are still two stocks which we prefer.
Sanjeev, you were talking about as to how to get cautious in power. Let's get in another viewpoint here in the power sector. Jefferies conducted a power summit where they hosted the likes of NTPC, IEX, the regulator CERC in independent virtual sessions. Anisha is here with the top takeaways from all of that. Anisha?
Yes, the consensus from all the participants, whether NTPC, IEX or CRC, suggested that the power shortages are likely to continue, and they're not going to continue only for 18 to 24 months, but even on a longer term basis, there might be a power deficit situation that we might be staring at, and that was of course the key takeaway from the Jefferies Power Summit. The demand strength is actually driven by both the industrial as well as the household demand coming in, and it seems like that the consensus was also tilting towards the fact that power generation and T&D investments should rise by almost 2.2x to almost $280 billion over the next 5 to 7 years. In fact, if you look at the commentary coming in from the NTPC management, they are saying that the demand supply situation mismatch is likely to stay for the next 4 to 6 years. Clean energy transition is clearly accelerating, and overall power capex is set to be in a 4 to 5 year uptrend to cater to the rising demand that we have seen. They also talked about how the potential renewable business monetization plan are in the pipeline to ensure the value unlocking for the investors as well. Shifting focus to what the IEX management had to say, of course, they talked about how the market share of short-term power has already inched up to almost 13 to 15% versus sub 10% that we had seen a few years ago. But a large part of questions to them was around market coupling, and to that they said that market coupling without MBED is not a very reasonable outcome, and discussions are still ongoing with regulators and all stakeholders, and they are hopeful of a positive outcome for all of them. CRC also talked about how capacity expansion is one of the most focus area for the government right now, one of the most important focus area for the government right now, given the fact that demand is actually picking up. Tariffs for FY25 to 29 and market coupling were the key discussion points, and there also the regulator said that they are looking at balancing what the demand side is pushing in, what the business dynamics are likely to be. So overall, a positive kind of outcome coming in for the power sector, suggesting that power demand is here to stay, at least for the near term.
Right, okay. Anisha, we'll leave it at that. Kunal, do you see any pause coming in any of the power names? PFC, REC, NTPC, IEX, any other?
So IEX has been an underperformer. In fact, there could be a possibility that the stock could actually make a comeback from this 140-45 range where the stock has been trading in the last few weeks. REC, PFC on the other hand, I think these stocks are into an absolutely strong momentum. So what we can expect in this kind of a scenario is that possibly these stocks may get into a phase of a prolonged pause for themselves. I don't expect a major correction as such, because as of now the momentum indicators on the monthly as well as on the quarterly charts are still not yet entered into the overbought territory. Hopefully, or maybe if in the next few weeks if the rally sustains for these stocks and they get into an overbought territory, that's why we would start to get a bit more cautious into these names. NTPC also, on the other hand, the stock, I think around the 250 to 55 mark a few weeks back had entered into an overbought territory, went through a time-wise as well as a mild price correction, but now the stock is back at 280-285 levels. However, at this price, the stock is or the indicator is not at an overbought territory. So that's where I believe that the chances of the stock moving up higher, even crossing the 300 levels, is pretty much high.
Naresh, comment on some of these cement names that fired up yesterday. ACC 8%, Ambuja Cement 7%, and even something like a JK Lakshmi Cement was a buzz. What's your view on the charts?
So technically, good momentum in the whole space. So Ambuja Cements has finally come back close to the prices where it started falling off in February 23. So it started falling off from 500, 520. So a major breakout done in terms of price action. So it becomes a buy on dips closer to 480 to 490 levels if it comes down. But overall, it could go back to 580 to 600 on the upside. Then we go to ACC. Similarly, it still has upside towards that 2350, 2400 mark, which is where it started falling from in February 23. So a full recovery in both these names. JK Lakshmi, on the other hand, is a fresh breakout because that's a stock which has finally crossed into a 2-year high, or very close to crossing it, just a couple of percentage points away. So all these names in the cement pack remain a buy on dips at current levels. The risk reward may not be as good. So out here, one should wait off for a fade off move to actually buy the dips, continue to hold on to the position, add on dips.
Right. Sanjeev, curious to know if you've taken a look at Patanjali's Investor Day takeaways from yesterday. They're looking at growing the premium segment now and looking at expansion in the south as well.
Yes, I have been optimistic on this stock on the sheer weight that, in the mass consumption space, it is doing extremely well. And, we should attribute not only yoga to Baba Ramdev, but also his business acumen. I mean, I met him a couple of times, Aisha, and, his verbatim giving you of numbers on his EBITDA, on his margins have been superb. So I think there is still upside in this stock. It's a very good, pan-India play on consumption. And the underlying brand is doing extremely well. So, I think food for thought that any decline here would be an opportunity. Consumption names are strong. Also, Aisha, just to the point, IEX and SW Solar are two power renewable and power trading plays, in the sense that IEX as a trading platform will see 15 times more revenue, are two of our top picks in the power space. So we are relatively overweight on these two spaces, but on the overall picture, we are slightly neutral. But yes, Patanjali should be a good buy on any decline and add on over here at these prices.
Sure. You voiced your view on how you're looking at these platforms, and SW Solar, of course, has been quite the top pick from you. But Sanjeev, great to have you on the show. We'll let you go on that note, since we're talking about Patanjali. And what a case study, not just Patanjali, but Baba Ramdev is himself, according to Sanjeev Bhasin. Let me take it across to Sharad and get in takeaways from the Investor Day yesterday. Sharad?
The 4 key themes emerging from the Patanjali's meet includes premiumization, backward integration, brand upliftment, and also the digitalization part. Now, importantly, the company will be launching more premium products in the segments of dry fruits as well as sports. And also the company has roped in MS Dhoni as their brand ambassador for their soybean oil. Importantly, the company mentioned in their investor presentation that they will be expanding their oil plantation capacities, and also the commentary has come that they will be expanding their food business in the southern Indian markets. Apart from this, for the biscuit business itself in focus, there will be launches coming in the choco chip and handmade cookie segment, and also a brand upliftment exercise would be coming in the urban markets for this segment. Lastly, they will be also focusing on growing the premium segment of their edible oil business, which has a major chunk of contribution coming to the revenues. So overall, the focus would be on the premiumization and the brand uplifting part. That is what is the key takeaway coming from this analyst meet.
Let's look at Adani Group of stocks, and there are a couple of factors which are worth revisiting. First, the comeback from that scary low. I think it's just a real royal comeback. Adani Power, Adani Green, Adani Enterprises, Adani Port, and Adani Energy. But all Adani Group of companies do not have the same narrative. Some have different. All of them have different narrative. B, if one looks at the delivery-based numbers here, and which is what is I would like to point out, post at least in this week, the delivery-based buying in Adani Group of stocks yesterday was about 3.5 times more than the average, and we are looking at large delivery getting marked here. Adani Energy, Adani Total, Adani Enterprises. I'm talking about the large Adani Group of companies where there is a substantial jump in the entire delivery-based buying. Now, what has changed? I guess what has changed this week is that a lot of institutional investors and HNI investors, I think they're simply taking an assumption that since Adani Group of stocks represents a very large group of, it's a large clutch of infrastructure companies, and if there is continuity in 2014, then the policy making when it comes to infrastructure, power, roads, cement, that is not going to change. And that in a sense is a vote for continuity. B, Bernstein's come out with a good report today where they're talking about, it's not today's report, it's a 2-day-old report, but they're talking about factors which are at play now. Promoter share pledges have come down. Bond repayment is not an issue. And valuations are much attractive than what their averages are. So a lot of factors have come together. The verdict of state election, vote by institutional investors for continuity, the fear of the market in terms of bond repayment and the promoter pledged, all of them have got addressed. And the price in this week itself has been nothing short of quite eye-popping. Himang Jani, why have Adani Group of stocks really come back in last 2 days?
Good morning, Nikunj. If you look at the chronology of events, Nikunj, first we had Supreme Court, withholding the order, but the tone of the verdict was that, they need to look at what actually are the facts, and we should not go by what Hindenburg said. That gave a lot of relief to market participants, followed by the state election outcome where, the BJP turned out to be a major winner and much better than market expectations. And people have also started building in, a swift victory for the current alliance, in Lok Sabha. So, a part of that has something to do with this chronology of events. And I do think that it's a high beta company. We also had some positive news flow in US market, though I'm not too sure about the reliability of that. That the due diligence which was undertaken by a US agency on the loan given to Adani Port, also there was something positive. So my thinking is that if you really want to participate in this pre-election rally, which will, let's say, continue till about February or March, Adani Group would surely be at the forefront of that. But since it's a high beta, name, it would be good to have, smaller investments in names like Adani Port and Ambuja, because the rest of the stocks have really run up too much, and there's no logic in talking about valuations, etc., because this is more about the sentiment and what could possibly happen in terms of flows.
So what is the best way to bet on this pre-election rally? Himang Jani, history has indicated that 4 out of 4 times in last 20 years, markets have rallied anywhere between 5 to 15% in the run-up to the election.
Absolutely. I think, what is important, though we all may have this feel that the market has run up quite a lot, but if you look at the Nifty and the Bank Nifty year till date, I think we have not had any meaningful upside, despite the fact that the earnings growth has been so stupendous for last many quarters. So yes, mid caps and small caps have run up, but the Nifty, the banks, and many stocks which are part of Nifty have not run up. So I think it would be a great idea to look at some of the Nifty-based stocks, be it in banks, be it auto, domestic consumption, some of the FMCG names. ETC has started moving after a long time. Titan, so I think consumption and capital goods and banks, these are going to be the main solid pillars on which you can build your pre-election rally portfolio.
Okay, now this is a very important question. I'm going to be asking this perhaps to everyone now. Kunal, Nuresh and Himang, since you three are there, so hear me carefully and you got to just be honest with this one. Are you guys ready?
Absolutely, yes.
Arey Nuresh, हाथ तो दिखाओ.
Yes, yes.
Okay. What is the best case scenario for the Nifty in the run up to the election? Give me a Nifty number. Starting with you, Kunal.
I thought I'll be the last one. So I think run up to the elections, if you ask me, the best case scenario would be closer to 25,000.
Oh, 25,000.
Yes.
Do you realize how far is that?
I think it's very near.
4,000 points. So you were saying that Nifty could actually rally by 4,000 points in next 5 months because elections are in May, actually 6 months.
Correct.
So 1,000 points a month is the kind of run rate what you're talking about.
Yeah.
So you feel that we are in the middle of a ferocious bull market.
Absolutely, yes.
Okay. Kunal has raised the bar high. Anybody wants to beat that bar? Nuresh?
I would not beat the bar. I'll continue to be conservative. Look at 22,500 as an upside.
Okay, so 25,000. We'll make a graph of it just for the reference of our viewers. 22,500. Okay. Okay, Hemang Jani, the easy way out is that you can come in between 25,000 and 22,500.
Yeah, so Nikunj, my take is simple. We are in a bull market.
Give me a number. Give me a number. Give me a number.
So you can easily see a 15% kind of an uptake. So you get, let's say, about 21,000. So I would think that 24, 25K is very much possible, Nikunj.
Now this is interesting, and I thought I was underestimating the market mood, but Kunal feels that Nifty could touch 25,000 in the run up to the election. Nuresh is keeping it slightly conservative, but when I say slightly conservative, he's of the view that Nifty could add another 1,500 points in the run up to the election. And Himang Jani is saying he will not be surprised if the Nifty stays or moves between 24,000 to 25,000. And that's the point which I think I want to bring out in terms of the underlying texture of the market. I mean, it's like saying that the bulls are out and the floodgates have opened. And large cap stocks, in a sense, have really done nothing. So even if you assume that markets add another 15% from here in next 6 months, and you start from 1st of Jan 2023. So 1st of Jan 2023, you're up 12%, you add another 15%. On a 1.5 year basis, that would not be a great, fantastic out-of-box return. That's the limited point we're trying to make here, is that there is value in large cap stocks. Okay, now the next one. I'll start with you, Hemang. Bank Nifty, how much can it accelerate in the run-up to the election?
So Nikunj, year till date, Bank Nifty is just up 9%. It has underperformed Nifty. Nifty itself actually has gone up only about 14%, and part of that is, it has happened in last 2-3 days, as we all know. So I think when it comes to Bank Nifty and banking stocks, there is a massive room on the upside, though it's a little high beta. I think the way it is revived, you can see banking stocks and Bank Nifty outperforming Nifty in a major way. So if we are looking at a 12-15% kind of an uptick in Nifty in run up to this elections, Bank Nifty can easily do better by 5 to 10 percentage points. So I think it can move up by 20-25% very easily.
In terms of an absolute number, then Kunal, what would be your number for the Bank Nifty? You've raised the bar higher, Kunal.
So I'll place it closer to 56,000 for Bank Nifty. So my estimate is 56. So my estimate is around 35% from the October lows for both the indices, 35 to 36%.
Really? That's super optimistic, no?
No, I think that's on a realistic mode.
Well,
see, I strongly believe, just to add that point, bull markets.
Why are you laughing, Hemang Jani?
Yeah.
You don't believe his numbers?
No, actually.
No, then why are you laughing?
No, I just overheard somebody saying that isn't that fantastic, and Kunal said that I'm being realistic. So I'm saying that these numbers, people are taking a realistic view, which is great actually. I am also of the view that we are in for a bigger upside, and I do think that there's a lot of scope for improvement.
Nuresh, sometimes when we hear these numbers, we tend to think, and I think the expression on your face, the fact that you're just maintaining that same stance means that you are, you don't know how to react. Give me your number for the Bank Nifty.
So the case is being a trend follower, you just ride the trend and not keep a lot of targets. But given the Bank Nifty has given a fresh breakout, so I would expect at least a 10% upside from those levels. So that number comes to around 51,000 roughly.
Okay, so what are we getting here? We are getting a number, and these are based on Kunal's and Nuresh's years and years of technical analysis. Kunal is talking about a number of 25,000 on the Nifty. Okay. He's talking about a number of 56,000 on the Bank Nifty, right?
Yeah.
Okay. And Himang is also endorsing that kind of a number. So I hope Kunal and Nuresh and Himang, they get it right. But that's markets for you. When large cap stocks, when they rally, and it's like a spring which has been unwound, and now that spring has been unleashed. And that's the power of a bull market. The brute power of liquidity and the brute force of momentum. It really could be at play in large cap stocks, considering the current setup for India is just so favorable. I'm going to just sip some tea, take a moment to digest these numbers. I mean, I'm a bull by nature, I'm an optimistic, but when you hear such numbers, Avan, an optimist like me also needs to say, okay, I mean, I hope these are not very high watermarks.
And they're all saying it's very realistic expectations. So yeah, maybe you want to do a second take on those numbers, but our chartists and our fundamental guests seem pretty confident on those levels. Well, speaking of a sharp run up in the markets, there is a case now perhaps to move to large caps. Let's hear out what some of the other big market veterans have to say. What is it that they're advising?
Markets are expensive, there is no doubt about it, from a 12-month perspective. But there are investors who are willing to pay, let's say, take 3 or 4 year view, specifically even the foreign investors who are willing to take 3-4 year view. If I couple that with the certainty of growth in India, right? So then market doesn't look that frothy or that expensive if I take a 3-4 year view. I feel that large caps will also do well here from here on, because if the money comes, which it will, even from the foreigner, given the sentiment and given the overall stability, then the first round of money will come in large cap.
While the small and mid caps in general and the broader markets have done phenomenally well over the last 6-9 months, I think the large caps in general have lagged. And so I think investors want to participate. It's time, in my view, that elephants will dance. So I think there is still an opportunity in the large caps. Not to say that there is no opportunity in the small to mid caps, but I think in a bull market, there's always sector and market cap rotation.
I think large caps will do well, because it is easy for new investors, particularly foreign investors, who are looking at India seriously, not only because India is doing well, but because they are getting bugged out of shape in China. The larger cap financials is the easiest to buy. They're also a large part of the index. So even if these guys underweight, overweight, they still have to put, if not 30% then 25%, but all that has to go into the same large cap names. And within those 3 groups, which is financials, consumer, and IT, it is easiest to buy financials because they are doing well and the stock prices have not done well.
General fact that the retailers are making money across all segments. They're not limited only to equity. Gold is doing exceptionally well. Bitcoins are doing fine. Irrespective, housing is doing very well. So generally, there is wealth creation across sectors, which will generally cause greater interest in asset classes, of which equity will also be a part, because you could have a diversified portfolio. The next is the return of FIs, and I think that is going to be a big catalyst for the market. Many people make a statement that the retail is the only element in the market that matters. Retail has caused us to reach where we are. FIs will cause us to move ahead from where we are, because they will now, there's likely to be participation, particularly in the large cap names.
All right, let's find out what those mid-cap trading strategies are from our chartists as we're digesting those pre-open rates, by the way, at 20,900 on the Nifty and up 200 points on the Sensex. Naresh, your top mid-cap call.
So that would be a buy on Sun Pharma advanced research company Spark, which has given a good breakout and sustaining around the breakout levels for the last few sessions. The stock has given a cup and handle breakout above the 270 mark, made a move to 285, did a retest of 270-75 levels, and now is making a fresh move, expecting a target price of 330 in the short term, stop loss at 265.
All right, watch out for Spark. And what about you, Kunal?
So, Himadri Specialty Chemicals is something which I highlighted yesterday. It looks very attractive at current levels of 290, 292 where the stock closed yesterday. Would look out for targets of 305 on the very short term and stop loss to be kept at 285.
All right, let's take a very short break. Come right back as we continue to dissect the stocks to watch as well as the run up to the market open today.
Hemang, if Nifty has to, let's say, go closer to even 23,000 or 24,000, which is one stock, which are two stocks which you think will be the engine stocks, which will be the driving it?
So, Nikunj, is that question for me?
That's right, Hemang.
Yeah. So I think, as I said, banks are going to be at the forefront of this entire rally. And I think HDFC Bank and State Bank, these are the two names where I would be very comfortable, buying into because performance-wise, they are delivering. US bond yields have picked out. Here, you're going to see a good amount of growth, both capex-led as well as the retail-led. So I think banks is where I would be more comfortable, getting into.
Okay, fair enough. What about IT? Given the kind of underperformance that we've witnessed, Hemang, what's the view?
So yes, in this entire rally, it is in the sidelines, but I do think that, from a valuation perspective, the sector is looking good. And at some point, I don't know when, but when this momentum slows down a bit, there is going to be some sort of a sector rotation. And from that perspective, IT should bounce back. I think apart from the large cap ones, I think the larger interest will be in the niche company, in the mid cap space. So, your Map My India, your data analytics company, some of the other mid caps like KPIT, those are the name, Birla Soft, where you would see a little higher outperformance come through.
Okay. This FADA's November data which has come out where retail sales, and again we're talking about November, which actually is Diwali, so you cannot look at that data in terms of isolation. Naresh, stocks like Suzlon, JP Associates, Reliance Power, some of the rank mid-cap stocks, they've already started turning. So has the rally in some of these so-called rank mid-cap stocks, two-digit stocks which have been massive outperformers in last quarter, is that getting over now?
So I would say it's more of a pause because if we look at these names, these are the only survivors. So for every survivor, so for every Suzlon, there are 3 other companies which got delisted in the sector. Same is the case with the power and infra. So it could surprise if the trend changes and the economic momentum continues. We've seen this in cycle by cycle. So Suzlon may be a 2-digit stock, but it's a 50,000 crore market cap company. Even a R Power, for example, is a 2-digit stock. It's a 8,500 crore market cap company. So my view is some of them could survive. So out here, if somebody has been owning onto the position, can book partial profits and then ride on to the move. But yes, in the near term, they're overdone. A lot of these names are up 2x, 3x in the short term. But does it mean a major top? I would doubt that.
Right. Okay. Great to have you then on the show right now, Hemang. Thanks as always for taking the time out and speaking with us. While looking at the GIFT Nifty, it seems like the implied open already is notched up at that 21K mark. So let's tell you what are the headlines that are outside the world of equity markets, and actually not quite, because Apple's market cap as well is now closing in on that $3 trillion mark for the first time since the month of August early this year. The first time Apple closed with a market cap that a high was back on June 30th. Apple, which is by far the most valuable company in the world, has enjoyed almost a 54% surge in its share price this year alone, riding expanding profits and broader tech stock rally. And Israeli troops have intensified strikes against Hamas terrorists in Gaza a day after they called for more evacuations in the Strip. Death toll in the Palestinian enclave has reportedly now crossed 16,000, while 80% of Gaza population has been displaced already. And back home, after massive destruction in the Fury in Tamil Nadu, Cyclone Michong has now weakened into a deep depression central coastal Andhra Pradesh. In Chennai, the flooding followed by heavy rains, which was triggered by the cyclone, which claimed 17 lives so far. Meanwhile, schools have been shut in the state of Orissa as well for today. And the Rajput community in Rajasthan has called for a bandh in Jaipur and Jodhpur after the murder of Karni Sena's chief Sukhdev Singh. After the attack, massive protests broke out across Jaipur, Alwar, Udaipur as well as Muradabad. A member of Goldie Brar gang has claimed responsibility for this murder.
Well, for all the cover right before the bell, let's go to Sharad.
Bandhan Bank is in focus, and the street buzz is that a recovery is expected to soon for its credit guarantee fund. Now this is coming in for the micro units. Now the overall audit process is also nearing its completion as what the street buzz is, and importantly this would be a recovery coming in from the impact of the Assam flood which was there in the month of June this year. Now because of that, the financials are also expected to improve in Q3 or at the max at Q4. Apart from this, the key managerial person CFO is also expected from a marquee bank to join at the same time as well. Now looking at the stock movement itself, stock has just given almost 2% return to investors this year, while Nifty Bank has actually given more than 9%. Now importantly, the analyst community is still bullish on the stock, and out of 28 analysts, 80% of them still have a buy rating with a target price set at 270 rupees per share for the next 12 months.
Right, and why is Asian Paints on our editor's radar? Let's listen in.
See, let's look at the problem for the entire paint sector. Competition is only intensify. But just because competition has intensified, that does not mean that there is going to be a change in terms of market share. Since we're talking about two-wheelers, let's use that as an example. Everyone said, okay, Triumph and other Harley and other bikes are coming in, that is going to eat into the market share of Eicher. But guess what? Eicher's market share is protected because of the unique offering they have. I think Asian Paints, in a sense, has a huge advantage in terms of brand reach and distribution. And now that growth is coming back and crude price is also supportive, I also feel that this entire view of the market in terms of what competition can do, I think has been over amplified, because Asian Paints in the past also has demonstrated the ability to do something very different. It's a professionally run team, and I think they've done excellent work there. The problem for Asian Paints was valuation, which I think are now looking reasonable. Second was crude, which is now manageable. And see, when a company like Asian Paint on a large basis is talking about such a volume growth number, it's a conservative management, they always shy away from making forward-looking numbers. Then you would say that, okay, they really mean business here. Asian Paints is nothing else but it's a multiplier on GDP. GDP plus couple of percentage points, and that's how Asian Paints would grow. And if GDP is growing at this rate, then demand surely is making a comeback. So let's see, time will tell whether this bullish thesis will come right or wrong. But I've seldom seen that large brands, they feel a shakeout even when competition has intensified, even though they may be coming from the house of Jindals and from Birla. Look, when Jindals came in, we thought, okay, it's going to change the dynamism. It has not changed the dynamism. It has come and gone. I mean, it's not eaten into the market share. And other players, there were so many players, but what has happened? Only 3 players have survived. Yeah. So it's not going to be like a cakewalk for Grasim.
Okay, let's tell you what the index strategies are this morning. And, up until yesterday, Kunal was actually recommending booking profits both on the Nifty and the Nifty Bank. This morning, it's Naresh who says book profits or part profits, and a buy from Santosh Meena, hold from Kunal. That's the Nifty view coming in this morning. For the Nifty Bank as well, it's pretty much the same call. A hold from Kunal, book part profits from Naresh, and a buy from Santosh Meena.
Naresh, if you think directionally markets are headed higher, then why book profits at all? I mean, just stay on the course. Keep on, in a sense, rolling over your positions.
So essentially, if you've got a trend from 19,500 odd levels all the way to 21,000, you want to take some profits off, partial profits, so that it becomes easier to digest any interim dips which may come, and you can again get back in. So the logic is just to take some partial profits off when the trend has given a good enough mature move. So it's been a good 6-8%, 10% move roughly across the board. So out here, time to take some profits so that you can digest any interim corrections and you have some say money left to actually go back and buy again.
Kunal, okay, we may say, okay, 100 points, you may time your market. 150 points is where you may get maximum if you're trying to be, you're trying to find a trade here. But if your view is 25,000 till election, then one should just not time at all. Stay the course. Nifty may come down 400 points, 500 points, but then just stay the course.
Yeah, so broadly, Nikunj, of course, for traders who've been on the long side and buying the index futures at lower levels. So, we started to recommend closer to 19,000, 19,200 on the index front. And I think from there on, we've managed to ride the rally for the indices. But, this kind of a view is more of a short term, where you may expect that the index is getting into a bit of a pause over here. You may either want to shift the liquidity or position size to either individual stocks, or maybe trim your positions over here and then look out for maybe intraday corrections like what we saw yesterday. And I think, for both the indices, Nifty and Bank Nifty, where there was a point where on an intraday basis, these indices corrected by 100, 150 points on the Nifty and say 200-300 points on the Bank Nifty, try and take opportunity of those kind of corrections.
Right. Naresh, index aside, do you have any stocks at the top of your mind where you say part profits here too?
So as of now, none of them really fit in a major way because a lot of stocks on the large caps are actually breaking out right now. So the only places you want to book profits is if you have some of these power financials, which is where the move has been very large. Or say something like a NTPC, which used to be a favorite before, has finally made that sort of a move from 140, 160 levels. The stock is at 285, 290. So Power Grid still has a lot of space, but in power, some names like NTPC has done too much. A recent recommendation, CSC has done too much of a 25% move. So power related names, one has to be looking at, say, booking profits, because these are not companies which have a history of making very large moves and continuing. They are low beta generally. The beta has gone up majorly and they've gone up 100% to 200% in a lot of them. So yes, power financiers, some of the power names is where you want to book out.
Okay, 44 seconds to go. To say the screen is doing all the talking. There is a global push and there is a lot of local momentum, and that's a deadly combination to have: global push and local momentum. And then on top of that, there is a FOMO feeling and reasonable valuations. So frankly, if you are in large cap stocks, you would say markets are not expensive. Flows are going to be coming back hopefully, which is what it has evident in last 2 days. Global cues are strong and decent, so there is no scary global macro scare. It is not China or US or Europe. It is not war, geopolitical concerns are not there. So this setup in a sense is a setup which one would say is just like a picture perfect scenario, at least for the bulls. And are we in for a picture perfect start? Looks like we would be in for a picture perfect start looking at the cues. So the breadth is favorable. The market is now almost at 21,000, another 70-80 points here and then 21,000 on the Nifty. Adani Group stocks, they continue to gain weight, and you've got banks which are really giving it some company. Small cap stocks, after 2 days of splutter here and there, a little bit of chop and churn, they are also back on the screen, so to speak. So just 77 points more, and then it could be a print of 21,000. Any large newsmakers post the market? Nothing large. Macquarie analyst meet on Asian Paints. There is a note from CLSA on auto downgrade, but that's about it. I guess the mood point is still that there is a FOMO crowd which is now forcing itself to jump back into the ring, so to speak.
Yeah, just looking at some of the other names, let's see what Patanjali is up to. That could be definitely one stock on our radars. They're looking to grow the premium segment. They're looking at expansion in southern India. So that's the takeaway really coming in from the investor meet yesterday. Asian Paints, Nikunj just flagged off. Macquarie has reiterated a double-digit volume growth. The expectation for second half in the next 5 to 7 years is pretty strong. That stock holds up 1.5% as we speak right now. Bank of India, it's a sizable QIP which opens today, 4,500 crore rupees. That stock starts off with a move of nearly 2% in trade. And Power Grid, which has turned out to be a successful bidder to establish interstate transport transmission system projects, so look out for that stock as well. CLSA, by the way, has downgraded some of these two-wheeler names, Eicher, Bajaj, Hero, TVS, saying that the stocks are now fairly valued. So Eicher may be seeing a red tick, Hero is just marginally higher, TVS should come up for you on your screens next, and I don't think there's any material move or red tick rather coming in on these names. What's Honasa up to? Fireside Ventures, remember, yesterday was a seller in that near 2% block, and Norges Bank was a buyer with an 0.8% stake. So look out for what this stock does. Oberoi Realty as well, they've completed one of the payments to NRB bearings for a land parcel in Thane. So look out for what that stock does. There's of course Pharma too. There's a licensing agreement with Aclaris that they've gotten into. About almost a 1% uptick is what you're seeing on this particular name. But let's just look at what some of the private banks are up to and where this move in the Nifty is really coming in from. So I can see Axis Bank is absolutely flat. Let's see what ICICI Bank, HDFC Bank are up to. 0.5% to less than 1% actually is the move on these stocks. ICICI Bank is absolutely flat. Is it Reliance? Let's see the intraday graph of that stock. That will just come up for you on your screens. HDFC Bank, of course, has made a decent start. Reliance as well is a lot more tempered in trade. ITC, the Adani names, they're the ones which are flaring up ahead. Kunal, what trades are you punching in right now?
So I think ICICI Bank looks attractive from the banking pack, and I think the stock yesterday did pretty well, moving up above that 1,000 mark, and I think also towards its fresh highs. So would look to buy the stock even if there's a mild correction into the stock today.
Right. And Naresh, your strategies?
So that would be our buy on Maruti, which is setting up for a breakout into new all-time high. So this could go test the 11,300 mark in the short term.
Okay, just looking at the market texture, and let's just revisit some of the big movers from yesterday. So Adani Enterprises, Adani Ports, ACC and Ambuja, they were the ones which were really ruling the roost in trade yesterday. Kunal, as a sector, or as a segment or a cluster in the market, one of course can see the Adani Group names, they continue to hold out. But outside of this pocket, do you see any thematic or sectoral outperformance kicking in?
So sectorally, I think Bank Nifty as a larger group looks attractive, especially the underperforming ones, the private sector names. Most of the other sectors, for example, realty has played a very good comeback from the October lows. I think up more than 20-25% from that kind of a price band for themselves. The IT, of course, has been an underperformer, but I believe that maybe over the next few weeks, we may see better levels to try and buy or time the IT names. Auto stocks are going through a bit of a consolidation. They have not yet given a big breakout, and I'm talking of most of the underperforming names. I think the likes of Maruti, for example, Tata Motors is also getting into a bit of a stagnant zone around the 700 mark. So I think there is a pocket within these performing sectors which also could do pretty well for themselves.
Okay, Kunal, Naresh, we'll see you again later in the show. It's a good start, definitely. And we're now counting down to the 21K mark on the Nifty. But the Lal Street has really been on a tear ever since the state election results came in. So let's hear out some of the biggest market voices and where they believe the market is headed in from here. Hear it out from Madhu Kela, Hiren Ved, Safir Anand and Tahir Badshah.
It gives kind of a certainty for 2024 election. Significantly that there will be continuation of the same party and the same policy given the election results which have come, and considering that inflation has been very stable, interest rates have been very stable, currency has been very stable, and there is no major volatility in any of the front, right? And the fiscal situation of the government is also very stable. So this all points towards, more higher valuation than what we have seen in the past.
There is still an opportunity. While the small and mid caps in general and the broader markets have done phenomenally well over the last 6-9 months, I think the large caps in general have lagged. And so I think investors want to participate. I don't think we've reached those absolute bubble valuations. How can we talk about bubble valuations when until recently your Nifty was for 2.5 years was largely in a consolidation phase.
Fall is the GDP data, which has now caused even the rating agencies to upgrade their estimates for India. It was far ahead of expectations. The second is the turnaround that is happening in many PSUs. I heard our petroleum minister speak about 50,000 crores profit in BPCL. And there has been so much of skepticism around owning of these companies because they've not seen as profitable companies and more of dividend plays, but that's completely changing. The next is the return of FIs, and I think that is going to be a big catalyst for the market. Many people make a statement that the retail is the only element in the market that matters. Retail has caused us to reach where we are. FIs will cause us to move ahead from where we are. I personally feel that the stability of the government will cause them to be able to pass more bills in the parliament.
Growth prospects, which are definitely better than most of the rest of the world. And alongside which, what we are also witnessing slowly and steadily is the stability of the currency. The rupee has behaved a lot better and has been, depreciating a lot lesser than what it used to in the past. We have seen about a 4% depreciation in somewhere between 2005 and 2013. And in the last 10 years, it's been more like 3%. And probably with the initiatives that we are currently on with, if we see a relatively better stability in the rupee compared to versus the dollar, then I think that will probably add to the, more positive sentiments as far as foreign investors are concerned with it.